At today's trading, Head of Research and Trading at Australian Stockwatch, Chris Conway, is actually joining us live via Melbourne, our studio in Melbourne. Chris, great to see you there. Thanks very much for joining us this afternoon.
Good afternoon, Leanne. How are you?
Very, very well, thank you. Although not such a good day today, another down day, and it's led to another negative week for the Aussie market. In fact, the fourth negative week in a row now. What's prompted this selling?
Look, I think it's all got to do with shifting expectations regarding what the Fed's going to do. As you rightly say, it's the fourth losing week in a row, fifth out of the last six. And we actually started the week on a positive note. We're up around 55 points on Monday. Of course, we didn't have any leads Tuesday because there was the public holiday in the US. But it's really in the back half of the week that we've sold off quite aggressively, with a big sell down coming yesterday and today. What I've taken out of it is that the sell-off has actually been quite broad-based. You know, there's been a lot of sectors that are down more than 1%. And just to take yesterday in isolation, it was interesting because the night before yesterday's session, oil prices were actually higher. And of course, we know oil has been pushing higher of late. Yet energy plays were down. So I think it's a bit of a reset for the market. I think, you know, coming out of reporting season, or coming through reporting season, the lofty position of the market probably wasn't quite justified, and I think the market's resetting to new expectations about earnings.
And of course the market's really looking ahead to that OPEC meeting, that upcoming OPEC meeting, where there's still so much talk around about a potential deal or a freezing of production at these levels. So we are continuing to see that volatility in those oil prices, which is obviously prompting a lot of those energy stocks sort of moving, you know, about quite a bit at the moment.
Yeah, look, absolutely. I mean, that's the ongoing narrative with OPEC and Saudi Arabia and Russia, and whether or not they can strike a deal. You know, we have seen this movie before, so I don't think anyone should be too surprised if we don't get everything that we hope for with regard to production cuts and agreements. But look, you're exactly right. Oil prices will remain volatile, and it's actually a bit of a shame to see that the equity market hasn't followed oil prices higher. We know towards the start of the year the correlation between US equities, indeed Australian equities, and oil was very, very strong. But of course that's broken down recently with oil pressing higher and equities tumbling lower. So it would be nice to see that if they can come to some sort of agreement and oil prices do continue to press higher, that it gives a bit of a leg up for the equity market. Remains to be seen, however.
Yeah, it certainly does. Now, let's actually talk about that retrace that we have seen, because we touched a high above 5,600 back in July, but the index is now retraced back below that 5,400 mark, and I'm just looking now, 53.47 that we've closed at today. Is that concerning that we've breached that 5,400 level? I mean, what does it mean? Do you think we're heading lower from here?
Yeah, look, it is a big concern for me. I said all through reporting season, anytime anyone would listen to me and anytime I was on the show, that I really wanted to see the index hold 5,400 if it was tested through reporting season and, of course, post-reporting season. Now, of course, it hasn't done that. It has slipped below 5,400, and we're back in that muck, in that range that really held us captive for essentially a year. So we're back amongst that muck. There is some uptrend support, or an uptrend support line that intersects around 5,300. So if the market sells off another 40 or 50 points, hopefully we can find some support there. But below that, there really is not a great deal, at least technically, holding this market up. So it is a little bit of a concern, but it's more so that, you know, now that we have slipped back into this range, it took us so long to break out of the range. Like I said, nearly a full year last time. I certainly hope it's not the case again this time.
Yeah, let's certainly hope not. And we are actually just looking at the chart that you've provided for us there, Chris, and as you say, that uptrend support line there intersecting around that 5,300 mark. Is there anything else significant around that chart that we should be looking at?
Yeah, no, obviously the annotated line is, yeah, as I said, intersects through 5,300. The reason why I've highlighted that is it really is, to me, the last sort of major support. It's the last bastion for the bulls to defend if they want to hold this market up, purely from a technical perspective. Don't get me wrong, of course, as the equity price or the equity index comes down, you know, valuations will come down and they'll be more attractive, and, you know, there'll be some fundamental support there as well. But just purely from a technical perspective, once that fails at that 5,300 region, I personally can't see a lot holding the market up. Maybe we retrace further back into 5,000.
Now, you mentioned there one of the observations was that the selling has been broad-based. You haven't sort of pinpointed one specific sector, but it is evident that those growth stocks, those bond proxy stocks, which have held up the market so well previously, they seem to be getting belted at the moment, the likes of the REITs, Blackmore, Sydney Airport and so forth. Why is that the case?
Well, that's all about the changed expectations regarding what the Federal Reserve will do. You know, everyone was, well, at least more likely to consider the possibility of a September rate hike. We saw some ISM numbers earlier in the week. I think that's shifted now to, if they are going to go this year, they'll go in December, so September's off the table. So it's that changing expectation about when the Fed may or may not raise interest rates. And, you know, the other thing, of course, is, again, through reporting season, everyone was talking about those growth stocks, those bond proxies, being an overcrowded trade. Now, anytime you do get an overcrowded trade, it only takes people perhaps to even start talking about it and talking about it en masse, as a lot of analysts were, and then all of a sudden everyone's drinking the Kool-Aid and believing it, and it becomes a self-fulfilling prophecy. So it has been those growth stocks that really have been sold down aggressively. You know, you look at something like a Blackmores that was at 220 and now is at 120. You know, something like a Bellamy's that is well off its all-time highs. Like you said, the REITs. That crowded trade has unwound, and that was really the thing, and yield plays that had been holding the market up. So once they fail, you know, it spreads to the rest of the sectors, and then we see this broad-based selling like we've seen for the past couple of days, where everyone just goes, seems like the party's over for the minute, we're going to move to the sidelines and we'll wait to see what happens next.
Yeah, it's really like the market is looking at it as a bit of an inflection point with those US rates, the question that we're all grappling with, whether it's going to be September or even December for that matter. What's your own personal view? I mean, do you think the sell-off in these growth stocks will continue to be as aggressive as what we've seen over the past few weeks?
Yeah, look, I've probably got a slightly different take on it, Leanne, than some other analysts out there. I think the Fed will go in December. I think they almost have to save face and to fire a shot before the end of the year. So it'll be, of course, similar to what we saw last year. I think the worry, though, is what happens further out. You know, September, December, does it really matter? No, probably not. But it's the rate of hikes that I think concerns a lot of people. I'm of the belief that when the Fed does start to normalise rates, it will be a much slower process than maybe some other people think. So let's not forget that the thing that spooked the market in January this year was not probably the 25 basis point hike that they did in December. It was the fact that they said they were going to raise another 4 times this year. Of course, we know it hasn't happened, but I think that was the thing that spooked markets, because everyone was like, well, if they're going to raise rates that quickly, well, we don't want to be in some of the stocks that we've been in. We're going to sell everything down, hence the 7 or 8% sell-off that we saw. I don't think we'll get that same sort of commentary this time. I think the market is once bitten, twice shy. A 25 basis point rate hike in the scheme of things is largely irrelevant. And I think people will understand this time that, you know, it might be 2 next year, maybe even 1 next year, and it's going to be a long, drawn-out, gradual process. So that being the case, I think the sell-off that we've seen in some of the growth stocks maybe provides an opportunity. You do need to have some courage to take the trades, and I would suggest absolutely that they are trades rather than investments. But if you can buy into the weakness now and get a bit of a bump because everyone realises the Fed's not going to raise as fast as perhaps has been thought previously, then you might catch a bounce in those growth stocks, given that they have sold off so aggressively.
And in light of that, I mean, at the end of the day, all this money has to go somewhere, right? So where do you expect a lot of that will be deployed? Do you think everyone's going to be revisiting potentially the top end of town?
Yeah, I do. So aside from the opportunities with those growth stocks, I think an ongoing theme that we're going to see over the next 6 to 12 months is that money will flow back into, well, not all of the top end of town, but certainly some of the top end of the town. So we're currently long CBA. We don't mind the banks at these levels. They have solid yields, grossed up yields. CBA, for example, is our preferred stock. It's at the bottom of a trading range that it has bounced aggressively from every time it's visited over the last 12 months. You know, the miners, BHP, Rio, FMG, something like CSL that has sold off from $121 back into $100. You know, like I said, these stocks are at the top end of town. They've been largely unloved. They have underperformed recently. I wouldn't say just go out and buy the top 20 without thinking about it, but there are stocks within the top 20 that I think can do well in the environment that we'll see over the next 6 to 12 months.
Interesting that you are buying into CBA given their recent results. Obviously, we're on the softer side of things, but all of the banks, as we know, are facing a pretty tough time at the moment with competitive issues and regulatory changes and so forth. Of the 4 majors, do you believe that CBA is best placed to meet a lot of those challenges?
Yeah, look, I really do think that CBA is best placed. You know, a lot of analysts will get up and say that it's overvalued and it's trading on higher multiples than the other banks, and I would agree with that. But my counter to that would be, well, why would you buy a NAB that was in Clydesdale and spent 10 years in the UK achieving nothing? Why would you buy an ANZ that pushed into Southeast Asia and is now retracting from that business again because they didn't achieve what they wanted to achieve? CBA displays exceptional cost discipline, which is one thing that I would like to see in a bank moving forward. And the other thing is I don't think their results were as bad as quite as everyone else maybe pegged them at. You know, their bad and doubtful debts weren't as bad as maybe some were expecting. Their margins held up. So I think there's, on balance, more to like than less to like. I think they're the best place because they've got the strongest management and they haven't made some of those blunders that the other banks have made in recent times. And, you know, you marry it up with the technicals, like I said, it's the bottom end of a trading range down towards that $70 handle. Every time it's visited this region in the past 12 months, it's bounced aggressively or semi-aggressively. So we've got an upside target on it at 78. And, you know, like I said, that's why we prefer it of the big four.
Okay, fantastic. 70.87 closing out there today. Chris, let's recap some of the news this week. Obviously, earnings season over, but there's been still a few stocks and earnings trickling through this week, notably Sigma Pharma. And I'm just looking, it was one of the star performers again today, rising 9.3%. Came off the back of that result this week and obviously an upgrade to their guidance. Has that changed the outlook for you, for Sigma?
Yes, it certainly has, Leanne, and I'm very proud to say that when Ingrid was talking to me about this stock yesterday, I said, don't be surprised to see this stock jump aggressively again tomorrow. Yep. If anyone doesn't believe me, they can go back and check the tapes. But I was pretty impressed with their bump in revenue. I think it was a circa 28% increase in revenue to north of $2 billion. Their margins remain pretty thin. They only made about $31 million off that $2.15 billion in revenue. So their margins are pretty thin. They held up though. I think more importantly though, they overcame some of the challenges that had dogged them previously. And the other thing that I was pretty impressed about, in March this year, they embarked upon a plan to move away from reliance on the PBS, the Pharmaceutical Benefit Scheme, and the revenues that come from that government-sponsored initiative, to making their chemists a more holistic sort of place where you would go and get some quasi-medical advice as well as other support services. So they started those initiatives in March this year, and it seems from their numbers that that has delivered results, and it's going to mean that further out they still don't have to rely so much on the PBS, which was one of the concerns that a lot of analysts had, and I think rightly so, that their numbers were being propped up by this government-sponsored pharmaceutical benefit scheme that was changing and is still changing and may not continue to provide the support and the revenue that it has previously. So it seems like everything that they could control, they have controlled. They've delivered a pretty strong set of results. I trust and believe that they're going to continue to manage their business away from relying on the PBS. And hence, you know, that's the reasons why yesterday I was on the show saying that don't be surprised to see it pop further, and here we are. Yeah,
well, fantastic. Well done on calling that today. Another 9.3% rise there. Chris, we'll leave it there, but fantastic having you on and taking us through that wrap of the week. Thanks so much.
Thanks, Leanne. Have a great weekend.
Chris Conway joining us there from Australian Stock.